And welcome to the Beyond the Dollar Signs podcast with Mark Taylan. Mark, good to see you.
Hi, Bill. Great to see you too.
Yeah, last episode we were talking about insurance, term insurance, permanent insurance, possible conversions. And it was a very interesting conversation. So for those of you who didn't hear it, I would encourage you to go back and listen to it. But this conversation really has me intrigued because you want to talk about universal life insurance. And looking over my notes, you posited this in a way that I had never thought about it before. Having set the table for you, explain, Mark.
So today's podcast is going to be around a life insurance policy called Indexed Universal Life.
Right.
Index meaning that it's indexed, the investments are indexed to like the S&P 500 or some kind of broad-based index. Universal life meaning that it's a permanent policy and you're making premiums to this policy throughout your lifetime.
Yep.
So it has all the components of a traditional life insurance policy where you're making payments. If you pass away unexpectedly, there's a death benefit that goes to the family. But today we're going to talk about Index Universal Life from the standpoint of an investment strategy as another opportunity for clients that we run into a lot. Quite frankly, we're in the Bay Area, and so when you've got a double house, what's the word, Bill? Two
Double
household
income.
double income
two
family,
households,
right?
Yep.
When you've got a double income family, you're probably doing a lot of what we see a lot of is most people are maxing out their 401k, taking the matches. They're typically their income is at the point where the threshold of being able to contribute to a Roth IRA, they don't qualify for.
Yeah.
They may have what's called a mega backdoor Roth strategy through their employer, but they really don't have a lot of options. I mean, they're doing the maximum amount of money. And if you think about the traditional 401k, they keep piling money into that. And at some point, they're going to have to pay taxes on that. So you're building a great nest egg, And so what other investments can people consider? Now, certainly you can take your after-tax money and fund it and fund a regular brokerage account, invest in stocks. That's one option. But I think another option that many people are not familiar with is using life insurance as another strategy. So today I want to talk about, again, the Index Universal Life structure. And so really what that is you got to go through the same process of underwriting. So first of all, you need to be insurable once you set that precedence, right? If with life insurance, that's the key caveat is if you're not insurable, you can't get the policy. But the way an Index Universal Life works is that when you make those, the goal of that policy is to not only you pay your normal premiums, and the premiums cover two buckets. The first bucket is it's going to cover the cost of the insurance. So whatever that death benefit is, let's say it's a $500,000 death benefit, and a portion of the money you make payable monthly goes to pay that death benefit. The second part of that, part of the premium, goes into another bucket of investments. And these investments are tied to the indexes. And so you've got a part of money that's growing. It's called cash value. So you've got think of it two buckets of money going to pay the term and the other one in a bucket of cash value. With insurance policies, it's very similar to a traditional retirement account. The money grows tax deferred, you don't pay any taxes on that money as it's growing. The Index Universal Life is unique in the sense that you are participating in index-like options. So the insurance company, let's say they're mirroring the S&P 500, you're going to give you you're not going to be invested in the market directly, but they're going to create some type of formula to where you participate in the market. So on the upside, there's going to be some participation in the market, and there is also a floor. With the index, what's beautiful about that is if the markets don't perform or they're negative, you just don't get a credit for that period of time. So the Index Universal Life is really, I think, one of the intriguing ways to invest without any downside risk.
Wow,
Um,
that is fantastic. I've heard people say that on the radio, and I've thought, I don't know. I wasn't sure. That this sounds like it may be too good to be true.
I hear that often too. And so let's take this concept a little further. So if you build these policies right, and so there's in the industry there's a term called modified endowment contract. And so for the contract not to be considered a taxable contract,
Yeah.
you have to do what's called a 7 pay, meaning that you have to make 7 years of consecutive payments to these policies in order to make sure it's in a tax qualified status. But really the whole goal is that you build these policies to create a larger cash value that can be used in the future. A lot of people, what happens is, let's say that you've done this policy in your 40s, and so you let this policy accumulate for the next 20 years. You
Hmm.
think of it very similar to your 401ks or your other retirement accounts or investments. Certainly over time, it's going to grow at a certain rate, right? It's going to, hopefully in that 20-year time frame, you've grown that cash value. So let's say by year 60, you've got a death benefit of 500,000 and you've got a cash value in the policy of 350,000.
Wow.
What folks do in that case is they use this as another bucket of money to draw in retirement. However, there's a key difference. If you think about when you draw from a retirement account, a traditional IRA, you take out $10,000 in a year, that money becomes taxable, just like you
Yep.
earned it, taxable income.
Yep.
With the IUL, the difference is that instead of taking a withdrawal, you take a loan against the policy. In a sense, that money becomes out tax free, right? So you take out the 10,000 tax free, and so you can use this bucket of money as another source of, another bucket that you can use to pay to supplement your retirement income, maybe to pay college expenses, or another place that maybe you need some liquidity for some type of renovation or remodel, but it's money that you
Yeah.
have access to in the future. So I think it's a very fascinating strategy that people are not aware of.
Yeah. So, in other words, so we're clear, the cash value part of of the universal life index here is an asset
Mhm.
that you can take loans against, secured by that asset. Is that
That's
correct?
correct.
Yeah.
Exactly right. So in the case where they've got 350,000 of cash value, they
Yeah.
could take out 100,000 out of that policy and not pay taxes on that. It's just a loan
Wow.
against the policy. And so let's say that a client did that. They took out 100,000, they passed away, right, unexpectedly or
Yep.
just normal causes. There was a loan against the policy for 100,000. The death benefit was 500,000. They intend their beneficiaries receive 400,000 tax free.
Amazing.
Yeah.
Wow. I this is really terrific. Um, Have you got any examples of any clients that you've worked with or people that you know in terms of this policy and how it's benefited them?
Yeah, it's exactly that way. It's like when you again, I think the key thing is it's a longer term strategy. You need
Right.
to be able to satisfy at least the 7 years. So it's good to do early on. And what I find is that clients that I've run into and worked with that have these policies, they did exactly that. They've created another income, another bucket of money that they have access to. And so really this policy, the structure of it really isn't for, it certainly does have a death benefit, but it's not used really in this way. It's really used as another retirement vehicle, another asset building vehicle, right? In the sense that it doesn't have risk if you're in the market because it has that floor. It gives you the ability to participate in the markets to an extent, right? Of the index that the insurance company ties you to. So
Yeah.
I think it's a really valuable, valuable asset to have in place.
Man, that is great. So just so we're all clear before we wrap this episode up, okay? Because
Sure.
I'm sitting here thinking, "Gee, Mark, this sounds really terrific," and I've got to admit, and this has nothing to do with you. This has everything to do with me. I'm thinking this sounds really too good to be true.
Uh,
Um, but I understand it's a real strategy used by real people. Um, and I'm wondering if you can give us an example of where that has been beneficial to somebody you've worked with or somebody you know.
mhm. Yeah, absolutely. Well, I think when you let me address the first thought you had is it's too good to be true,
Right.
right? And so again, every asset has its pros and cons, right? And a lot of times when you're presented with an investment, you kind of have to weigh, well, how does this compare to a traditional investment versus
Yes.
a versus this index universal life? And so I think the big difference is that this policy again, it has expenses internally because it has the cost of insurance. So you always
Sure.
have to remember that you are paying you are part of the premium is going to pay for an insurance death benefit.
Yep.
So understand that, so 100% of your money is not at work as it would be in a regular brokerage account. So there's the comparisons. However, there's the differences are, how when clients draw the money, what are the different you have to weigh them together. Is one more tax efficient than the other? How would you compare the distribution in a regular retirement account versus an IUL, right? The IUL is going to be more tax efficient.
Yeah.
Um, but the IRA maybe had less expenses because you weren't paying for the death benefit. So more of your money got to work right away. And I'll give you an example. So most clients, let's say they're funding $1,000 a month into these policies, right? They figured out, we want a certain amount of, you solve like anything else. You say, okay, I want this bucket to be X amount of money in the future. So you do the math and figure out, okay, then I need the policy is going to require X amount of money to be saved to reach that potential. And so it's the same process, but how much of that money is going to pay for the cost of insurance, right? So maybe that death benefit to structure it of that $1,000 is $250 is going to insurance, right? So it's the same concept when you're thinking about these IUL policies is the younger you are, the better. That I think that's the common theme when we
Yeah,
talk about
that seems to
insurance.
be the common theme with
Yeah.
all insurance. The younger you are when you purchase that first policy, the better it is because your premiums are going to be so much lower than if you wait to when you're in your 40s or 50s.
Absolutely. And I think that's a key point is that you have to factor in the cost of the insurance and the structure of the contract, right? And
Yeah,
so as we mentioned, as you just mentioned, the younger you are, the better. However, I have had clients and have had other advisors that I've spoken to and looked at cases where clients were older, and so
mm,
we used to say 30s, 40s is kind of the ideal age. But now we've seen like in your 50s, if you're insurable, it still makes sense. And so, what I recommend to people is explore the idea, find out, look at the details of an IUL policy,
right.
see if you can put more money in, it will benefit you in the long term. See what the numbers, how the numbers run out, right? Because you have to go through the underwriting process, and at the end of the day, the insurance company is going to say this is what the cost of insurance is going to be. This is what the premium is. And then you have to kind of weigh that and see if it still makes sense. So, certainly, it's plain vanilla. There's a lot of
Right.
moving pieces, but as an overall strategy, it's effective. And I've seen clients really benefit from this.
Now, one quick question because I've heard this and I don't know if it's true or not. Are the benefits that are paid out in an index universal life policy are they tax free?
They are. Insurance policies are tax free.
Very
Yes.
nice.
Yeah.
But clearly, this is a complicated strategy and product. S-
Absolutely. You definitely need to work with a qualified insurance
Yes,
advisor to build out the strategy that's effective for you and your family.
makes complete sense. Are you the person that would sit down and talk with them about this, or do you have insurance agents that you work with that
Yeah.
you refer people to?
Yeah, so our team is insurance licensed as well. So we certainly can, and we have a great team behind us that runs these illustrations, a great group. And so we certainly can help you with that. If certainly talk to, if you have an existing insurance agent, certainly you want to talk to them about the concept.
Hmm.
But you certainly would love to have that discussion with you.
That would be great. And if someone is listening to this and want to have that conversation, or maybe even just a different conversation with you, just to reach out and talk to you
Yeah.
about what they're doing in terms of their retirement and their savings and their planning, how do they get a hold of you, Mark?
Yeah, just reach out to our team. Our number is 408-778-8280. Our information is in the show notes where you can go to our website and book a Zoom meeting with us or come see us in person. We'd love to have you.
That that would be fantastic. And I would encourage you, if you have not had a conversation with Mark, if you're not a client of his, do reach out to him. He is an easy person to speak with, as you no doubt have noticed during listening to his podcast. As a matter of fact. So, the other thing I would like to ask you to do is hit the follow button and become a subscriber, because that way you then are notified every time Mark has a new episode. You can give it a listen. And there is a catalog of podcasts that Mark has available for you to listen to. And you can go back and listen to any number of other conversations as well and learn a few things, as they say. Learn a few things and get a little more educated, and definitely reach out to Mark and his team. And if you like that conversation, tell people about it, okay? Because word of mouth promotion is really helpful, either in terms of referring Mark to friends of yours or just his podcast. So we would thank you for that. Until next time, I'm Bill Tucker on behalf of Mark and everybody at Advisors 360. Thank you for taking the time to listen today, and we'll catch you next time.
Thank you.
Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own and may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.